Welcome back to the show. Andrew Hines here with the Andrew Hines Real Estate Investing Podcast. Today, we're going to be talking about the number one mistake Canadians make when they're investing in the US. And this is something that legitimately, I get messages from people trying to fix the mistake that they've made. And if you make this mistake, you could literally pay up to 100% of your profits in tax. So you do not want to make this mistake. We're going to be going over the two biggest ones, the two biggest hangups that are just going to absolutely crush your progress and hurt you if you're trying to do anything in the US as a Canadian. So before we get into that, I do want to mention to you, I never got to do this. When I shut down the podcast last August, I had like 300 plus people reach out, say how much it meant to them, and actually was totally blown away by it. I didn't know that many people were still paying attention. I had the stats, but just like that they were that tuned in. And I really wanted to say thank you for all that, like for everybody who stuck with this and is still subscribed, even though it hasn't released an episode in over a year until earlier this week. Thank you so much. And to the people who've reached out and commented and, are happy that we're back. I'm happy to be back. It's fun. I don't know where we're going to go with this, but we'll keep it rolling for now and do some cool stuff. We're going to talk some real specific stuff. So anyways, this is a absolute nuts and bolts episode. And, I spent a lot of time putting together a really awesome playbook that you can grab. And I'm going to stay tuned. I'm going to tell you how you can get that at the end of this episode. But I wanted to just pave the way for you so that you have all the information I wished I had early on, so I could have saved money, prevented myself from making these mistakes, etc. Okay, so where is the root of the problem here? If you're Canadian and you've done any looking at all, you've talked to people in the US about real estate or business at all, you'll hear them say, oh, you just need to set up an LLC. Oh, you do that in your LLC. Everybody talks like LLC. Like for a Canadian, for somebody in like Ontario, an LLC in anywhere in the States is equivalent to your corporation in Ontario. So in Ontario, it's very advantageous to use a corporation because you get the 12.5% tax rate for the first $550,000, and you get dividend tax credits when you pay yourself dividends. Like it works great. In the States, generally speaking, the LLC is what people want, and they rely heavily on their personal tax rates, which are much lower than Canadians' personal tax rates. So that's why they say LLC. Because an LLC is just a flow through. An LLC, according to the IRS, it's a disregarded entity effectively. If you have an LLC, it just protects you from the liability, but you still get to use and enjoy your personal tax rate. So if you're in the 20s or 30% range, that's the taxes you pay and no more. Which, if you're an Ontario resident and comparing what you would pay if you earn money in a corporation and then paid yourself a dividend, you're still paying way more in Ontario than Americans are paying. But that's what it means to be Canadian, pay a lot of taxes, right? Oh, and just quick caveat, guys, I'm just a guy that does stuff, that's done stuff. I'm speaking from experience here. This is for educational purposes only. So this is by no means tax or legal or accounting advice, none of that. This is meant to be used in conjunction with your accountant. So take what you learn here, and it's something to start a conversation. And most importantly, you need to know as an investor how to speak to your professionals because they don't always recommend the right thing, especially for Canadians. Like I know a guy who literally comes to Canadian events, and I've dealt with him, and he literally recommends that Canadians put LLCs in their companies, in their corporate structures. And he's setting them all up for failure. And he's still doing it. I've had it out with this guy. I'm not dropping any names, but I've had it out with this guy. And I know because of other people that I've heard come back to me, he's still doing this. He's still recommending people to use LLCs. And he's not the only one. So you need to be educated as to why you shouldn't do that if you're investing in the US. So by the time you're done this episode, you're going to have a very clear picture of what you absolutely can't do. And you're going to have a very good idea of how you would want to go forward with an entity setup. And then you just go to your professionals and you work out the details and get it all done with them. All right, let's talk about why the LLC is such a bad idea. So I just mentioned to you what the CRA thinks about an LLC, what the IRS thinks about an LLC. The problem is, the CRA does not see an LLC as being a flow-through entity. The CRA thinks an LLC is a company, a corporation. And the CRA So the CRA looks at it and says, you have a foreign corporation. We don't tax that. We'll wait till you take the dividends. So I'll give you a hypothetical example. Say you were in the US investing, you made $100,000 profit in your LLC in year one. The IRS is going to send you a tax bill. You might end up paying them 20%. So say you pay them $20,000. Well, now the CRA is not taking a piece. They're not saying, hey, you earned anything, because the money was all left in the company. You didn't take it out. So say you left it all in the LLC's bank account. That's a non-event to the CRA because they don't recognize it as a flow through. So the CRA is going to wait until year two when you take out the $80,000 you have left, and now they're going to tax you on that. So now they're going to apply say you're in the top bracket in Ontario, they're going to apply the 54% tax rate, and now you're at 74% tax on all profits made effectively. It doesn't work out exactly like that, but you get what I'm saying. If you were in a higher bracket, say in the US, you were in a high bracket and you had earned $1 million, good problem to have, $1 million in your LLC. Now you're going to be paying, 39% in the top bracket in say the state of Florida, and then pay your 54% in Canada the next year. So this is how you can get up over 90% tax rate. And if you were in, say, a state like California, it's literally theoretically possible that you could pay like 105% tax if you are Canadian and you set up with an LLC. So the big problem here is the mismatch between how the CRA looks at it and how the IRS looks at it. And what I just explained to you, I have spent thousands of dollars on and just dozens of hours to just try and get a clear answer from professionals. And if they just would have explained it to me that way, it's a mismatch. Just a mismatch in the way they look at it. One sees it as a corporation, the other sees it as a flow through. That is the mismatch. Boil the whole problem down to something very, very simple. But what you have is you have these professionals like the one I mentioned earlier, who I'm not going to name, who literally recommends to people, still set up with the proper structure. And I'll get to what the proper structure is, or one of the possible proper structures. They still say, set up with that structure, but then just put an LLC at the bottom. And that's no problem because you have the proper structure above it. That's wrong. I'm not saying you can never use an LLC. There are ways. And this is something, probably outside of the scope of today's talk, but there are ways. But generally speaking, for a Canadian, LLC is death. Don't do that. If you want to hang on to the profits you make the best you possibly can, you're best to find your own flow through solution. So what solution can we use as Canadians that will be treated as a flow through entity? And the only one that I've come up with that works that way is the LP-GP structure, which I'm going to get to in a moment here. So we did our example. One thing I want to talk about before that, just not to shift gears too much, is the issue of FIRPTA withholdings. And I know I'm throwing a lot of technical stuff at you, so I hope you came with your pen and notepad, and bear with me here. I know this seems a little bit, into the weeds, but it's kind of necessary to know. It's actually absolutely necessary to know, because if you don't understand what FIRPTA withholdings are, it's just as important as the double tax issue. What FIRPTA withholdings are is it's a withholdings for foreign investors, foreign people who are doing business in the US. And what it's intended to do is make sure that you pay your fair share of taxes to the US. And what they'll do is, if you sell property in the US, the default is, as a foreigner, if you're a foreigner selling property, they're going to withhold 15% of the gross value of the property. And you might be thinking 15% of the disbursement from the title agency. No, 15% of the gross sale price. So they don't care that you paid a realtor. They don't care that you have to pay off your mortgage. If you can't cover that, like simple math, say it's a $100,000 property and you've got a mortgage of $90,000. If you have to pay the FIRPTA and you're paying a realtor, so you're $5,000 to your realtor or $6,000 to your realtor, and then you got to pay off your mortgage at $90,000, you have to come up with the difference. So what does that work out to be? You're only getting $4,000 from the sale. So you got to come up with like $16,000 for IRS just to send them a check, just to sell your property. And here's the kicker. You don't get that money back anytime soon. Say you sold that property in January of 2025, you wouldn't be filing your tax return in the US until, for a lot of people, April of 2026. And then it takes time for the IRS to review and send you a check. They might not send you a check back till fall of the following year. So if you think about that, you could be without your money for 18 months, something like that. Imagine doing a flipping business at scale where every property you sold, that was the issue. You would quickly be out of business. You wouldn't be able, from a cash flow standpoint, to do it. So how do we get around that? Well, obviously, this is a huge concern for a Canadian. And what I just described to you with the LLC, if you did that, you would be considered a foreigner, because remember, the LLC is a flow through in the eyes of the IRS. So they're going to look at who owns the LLC. They're going to see a Canadian on the other end of it, and they're going to say that's foreign. This is a foreign ownership. Even if it's a Florida LLC or a Michigan LLC or wherever you're doing business, you're foreign. So how do you get around that? Well, there's a couple of ways, and I'm going to get into some specifics. But basically, you just need to find a way to make it not foreign. And the solution I'm going to talk to you about in a moment here is helpful for that. It's not the only way you could do this, but it is one way that it does work in my experience, because I've personally been doing it and not been getting this money withheld. And that is the next thing I'm going to talk to you about here. Just going to pull up my notes here. Okay, so this is the part where we're going to talk about the structure that I've used that does work. It's not the only one. I actually have a detailed document available for you if you really want to nerd out on this stuff. If you want to know everything about this and the different ways you could set up, I have the entity setup playbook that I've put together, which is all the information I wish I had. This is something I highly recommend that you take advantage of. And when you go in to talk to your accountant, to talk to your lawyer, you come in armed with this document. And then when you get that pushback, you don't have to argue it. You say, read the document, and then get their feedback on it, obviously. And then once they see the issue, they can then advise you correctly. That's really what it comes down to. So that document is available. If you go to www.investingintheus.com, you can download that document right from there. Just enter your information. It'll be delivered to you by email right away. So now back to what we're doing here. So the proper structure in my eyes that I see a lot of people doing, the majority of people I know doing, it's not the only way, but it is probably the most tax efficient way, is the GPLP. So it's a limited partnership is what it's called. It's a legal entity in the US. You can also form LPs in Canada too. But the LP is a flow through. So, which means that they don't, and CRA does not look at an LP as something to be taxed directly. An LP, you divvy up profits, and then the individual partners are each taxed at their own personal tax rate, which is about the best you can do when you're investing in the US. And it doesn't mean that you're not going to pay a lot of tax. You obviously still are, but it's going to stop you from paying double tax. So you're not going to pay tax once in the US and then once in Canada. You're going to get a credit for the tax you pay in the US from the CRA if you do it right. Again, you're going to want to grab that guide. It's going to help you to understand how that all works. So the idea with a limited partnership, and I am sharing my screen right now, so I highly recommend, if you're on the Spotify version, you can actually watch video now. Check it out. If you are on YouTube, obviously you can see the video. And if you're on the other platforms, maybe just take some time later, actually grab the guide, because I'm screen sharing from the guide right now. Okay, so limited partnership, you can see that down here at the bottom. That's the entity. And then that's the entity that will ultimately hold the houses, flip the properties, do what have you. And there's other nuance here needed, so still talk to your accountant. But this is the general structure that's used. And then you have a limited partner. And the limited partner is the person that's limited for liability. So they're not the person that gets sued. They're just the person that put in the money and owns it. And then you have the other partner, which is the general partner. So you remember what I said before, you can't be foreign. So if you're the limited partner and you own the whole thing, then that's foreign ownership. So what we need is a domestic ownership. And how do you get that? Well, corporations in the US are seen as domestic ownership. They're not considered flow through. So with FIRPTA withholdings, for that whole withholding problem, you're not seen as foreign if you have two partners. So if the entity is American and it has at least two owners, and one of them is not foreign. If they're both foreign, then you're same problem. But one of them is not foreign. Now the withholdings goes to the personal return. And that just means that at the end of the year, you file how much profit you make, and then immediately you have to send them a check, and then they just send you the balance back after taxes are calculated. It's a way better scenario, and you're only without your money for a couple of months at most versus like 18 months. And it's based on profit, not based on the gross sale value of your properties. So limited partnership right at the bottom there, and you have two owners right at the top. Again, much easier if you just download the guide. You can see the visual. It's on page 7 of the guide. You can see exactly how most people structure this. And person A at the top, that's the owner. So you can be a one-person ownership structure, but because you have that corporation in there that you own 100% of, that's the general partner. So that's your liability shield. So that, you set up your general partner as your corporation, which gives you personal liability protection. Again, talk to your lawyer. But that's just my understanding and how I conduct myself. So you can see in the graphic here that in this scenario, if you own these houses, you don't pay any tax at the limited partnership level. You go up to the personal level. You see a little man here in the diagram. And this person is 99% owner. And say he's in the top bracket in Ontario, he's going to pay an effective tax rate of 53%, 53.53%. That's the Ontario top tax bracket. So out of that, some of that was paid to the US. But when you get the letter back and you show the CRA the check that you paid to the US, you then get a credit for the taxes you paid, and you just pay the difference in Canada. So that's how that typically works. That's how you're going to want to structure yourself. For say 99% of people, that's probably how you're going to want to structure yourself, with some nuance. Maybe you have 2 LPs, depending on what you're trying to do. If you have an immigration angle that you're working on, you might do an extra one. That's something that we work with some of our students on, if they're trying to do that, just to give them an idea of how you'd structure. But that's the general idea of how you'll structure. So like I said, highly recommend grab the entity setup playbook for Canadians in the US. That's going to be an ultimate resource for you. Just head over to www.investingintheus.com and you can just enter your info right there. Grab that guide. It's going to help you out a ton. So just want to take a look back on my notes here if there's anything else that we wanted to cover for today. This one, because it was so heavy and technical, I'm not going to stretch it out. You can just rewatch it. And then, of course, really rely on the guide. Like I said, page 7 of the guide has the diagram. And I also talk about other structures that will and can work. So there are ways that you can set up with C Corps, like a corporation in the US, and even have corporate ownership in Canada. Because I get this question, I've laid it out in detail and talked about how much money you're going to pay in taxes if you do that. I've given examples so you can decide, because there is nuance. And just because I tell you that this is the most common structure I see doesn't mean it's necessarily right for you. This is why you got to talk to your accountant and your lawyer. But it is a very usable structure and obviously very common for a reason. So, but corporations are possible. You're going to pay more tax, but it depends what your planning is. And I dig into that nuance more in the guide. So if you're really set on, hey, I've got a bunch of money in a corp in Canada, I don't want to take it out, I want to use it for my Florida stuff or Ohio stuff or whatever you're doing, there is a way you can do that. And you'll see what the implications are in the guide. So check that out. Like I said, investingintheus.com. And then guys, make sure that you're subscribed here. Stay tuned for the next episode. I'm going to be going into the myths that stop people from investing in the US and debunking them. So if you're worried or you're thinking, hey, it's not going to work, or I can't do this for X, Y, and Z reason, I'm digging into those reasons in the next episode. And hopefully you get a lot of value out of it. Later in this series, I'm going to be talking about more of our stories, more of the deals we're doing. So you're going to want to stay tuned. And I thank you for joining me after all this time. 6 years ago, I started the podcast. So I really appreciate you're here. And we'll see you next week.